Hello, everyone, and welcome to The Buck Stops Here. I am Catherine Murray. Well, I'm very excited to bring to you today our next guest. He has been called the kingmaker of Canadian tech. He is very well known for incredible investments in some of the greatest tech companies in the venture world that have grown into publicly traded companies such as Shopify, just to name one. Huge success story. Wattpad, Hootsuite, Xanadu, just to name a few. Obviously, with volatile markets and high valuations in the private equity markets, how great to be able to get John Ruffalo to join us today. John, thank you so much. And you now have a new firm, Maverix Private Equity. Welcome, and thank you for sharing your perspective today with us.
Great. Thank you very much, Catherine.
So, John, give us a bit of perspective in terms of how you see the world today, because we know that there's just so much money chasing so many companies, and you've got 30 years of experience. Can you put this into perspective for us?
Yeah, I would call it, this is both the best of times and the worst of times. And I really do think that you're going to see lots of bloodshed in the markets for a lot of investments that were made largely due to a massive excess of capital chasing too few deals. And this excess capital has largely been has largely arisen because of the U.S. Fed policy on interest rates, which has shifted massive amounts of institutional capital away from more traditional conservative investing to high growth investing to seek some level of returns.
And so, I think a lot of people hear that and know it, and yet the money keeps flowing into these investments and also from institutions, who, are supposed to be the smart people, right? But we know mistakes get made. I mean, and you've seen it. So why is this happening? I mean, we all need to make returns. I personally am also investing in deals, and we all think we're going to be the smarter one that's not going to get caught.
Right.
But, I don't think that that's how it's going to play out. How do you see this playing out?
Yeah, it's hard because, I'd say what's the biggest driver is the fear of missing out. And, the old adage, markets are moved by both fear and greed. We've had 10 years of greed. But you're starting to see the fear. And what's happening is that we're getting, some massive volatility. Let me give you an example. Just yesterday, you saw that Facebook and PayPal, they've had some, I'd say, bad news, but not horribly bad news. Yeah. And the markets just annihilated Facebook, 20% decreases. I don't know what it's seeing right now, but why are these big reactions? Because the markets are so skittish. And what that tells me is, and the public markets actually are far more rational right now than the private markets. Private markets tend to lag on average about 6 months, and then you start to see the behavior changes. But what's happening is, even for mistakes that you might not think are that big, what's really happening is that people are bracing for the worst so that they don't want to be the last one caught in there. So I think this fear is starting to show up, and the real trigger point, which we fully expected, was an interest rate increase, largely driven in the U.S., and the tapering of the bond buying program. And now what you're seeing is that people started to price that in, but now they're realizing that the Fed may increase rates far greater than what was originally expected.
Yeah, so there's some people out there saying it's going to be 5 times in 2022. But it's always so interesting, John, because, that's been the fear. Maybe now we're realizing it. But so often what you think is the fear will not be the fear. Is there something else on your mind?
Yeah, I mean, the reality for me was the markets were overvalued. We all know they were overvalued for quite a while. But the massive excess of capital that we have in the world today, there is more dry powder of capital in the history of the world today. And that takes a while to filter through. So this excess capital has really been covering up the mispricing of assets. And it's
we'll leave it right on that note. Okay, welcome back. John, I want to pick it up on the point that you just left off on, which is the mispricing of assets. And you said during the commercial break, all assets. You know, anybody at home listening to this is going to say, I hope not my asset. And what do I do about this? Okay.
Well, let's look at just housing. You know, I'm not an expert on housing, but, you know, the very low long-term interest rates have increased the prices of houses. And, you know, and if you own a house, you're going, wow, I can't believe how expensive my house is worth. And if you're trying to buy a house, you're saying, I'll never, ever buy a house. Well, let's just pretend for the moment the average mortgage is at a 2% interest rate. And let's just say that's a, you know, variable. And, you know, my expectation really was that if the interest rates were increased only by 200 basis points, that is all the impact that I believed before things will start to turn on its head. And you might say, well, 200 basis points historically, that's not that big, but it doubles the interest rate. So if you're highly leveraged in buying your house and you're paying $5,000 a month, and that's at the edge of what you could afford, and then overnight you're going to pay for that same house $10,000 a month, it's a shocking impact. Well, now correlate that example to the stock market, and particularly growth stocks. That is the similar impact, and you get a double whammy in that. You know, when you value a stock, private or public, the purest way to value it is taking the discounted future cash flows from that business. Well, as interest rates rise, generally speaking, people buy less. And so your projections are less, hence the value is down. Once the value is down, markets move back to other safer investments, whether it's real estate, infrastructure, fixed income, et cetera. So you get this double whammy of decreasing capital and decreasing performance. And that gives you a double impact of resetting valuations back to around the historical long-term mean. And the last thing I would just say on that, you know what the biggest sign of this is? When somebody starts off a responses, but this time is different, bet against that statement and short that statement.
It's so true. You know, you learn that as a youngster on Wall Street, like it's never different this time. But at the same time, John, you know, we have to recognize that, my goodness, this, you know, Fed-fueled greed rally for over 10 years has gone on much longer than, you know, some of the smartest people in the room would have thought.
Yes.
And there's part of me, I hear exactly what you're saying, and I hear the double whammy effect. But there's also people who say that because of not only all the capital in the world, but all the amount of sovereign debt in the world, that, you know, the various governments and central banks around the world actually won't be able to increase the inflation 200 or the interest rates by 200 basis points. You know, and so maybe we're in this muddle through world.
Yeah, it's a great comment back, but I am actually deeply concerned. What you've implicitly said is that I remember a time when the central banks were independent of political public policy. And now I'm starting to see it intertwined because of the massive excess spending that's occurring. Low interest rates enable governments to at least manage that spend. But, you know, that can't go on forever, and you end up with a very nasty consequence.
Mm-hmm. Are you concerned? So, you know, I think that your comment about the political intertwine is probably Fed related. But what do you think about, or maybe it's Canada? What do you think? And are you concerned about how much fiscal policy and fiscal spending is going on in Canada?
Yeah, I mean, I'm deeply concerned by it. Um, all I was saying, why do I pay attention to the U.S. Fed? It's largely in the United States where you have the massive excess capital. In Canada, interestingly, you do not have massive excess capital. You just have low interest rates fueling government spending. So I think it's just it's a little bit of a different analysis, and whatever is going to happen in the United States will happen in Canada, and in the technology markets in particular, there is no border. Whether it's North America or the world, all of the money is fungible.
Okay, we're going to leave it on that note. We'll take a quick break and be right back. All right, we are back with John Ruffalo, one of the kingmakers of tech, Canadian tech and tech. So let's actually talk a little bit about that. But John, I really wanted everybody to be able to hear your macro and top-down views of the world, because you do have so much experience. And what's so interesting about the markets right now, particularly the public markets, there's a lot of hedge fund managers out there who've probably never seen a bear market. So that's why I'm so excited to be able to bring your thoughts. Right? Like, hello. And so anyway, having said that, how are you looking at the world? Because it is difficult to make these investments, and yet you have a private equity firm. So what are you doing?
Yes. Well, yes. So that's why I was saying it's the best of times and worst of times. So we raised a very large, at least for Canadian standards, a large growth private equity fund of $500 million US. It closed April the 13th. And we have screened almost 1,000 deals in about 10 months, which has been unbelievable velocity. We're about to close our first 2 deals, and neither of them are in the traditional tech space, largely due to the excessive valuations in that space. But the technology theme is a long-term theme that if you're not paying attention to or not investing along those lines, you are going to miss out. But you need to be smart about it. So the 2 investments that we are going to make are technology-enabled companies. Each one has a very strong business model. Oh, and by the way, this is a real novelty. They both make money right now. So,
love it.
Quite unbelievable, huh? And I think making money in businesses that have economic value as opposed to growth at all costs, I think that's going to switch as well too. But looking at technology as a differentiator or as a moat, you don't have to be the producer of the technology, but you better leverage the technology in a way to make your business better, faster, greater, and having more customer insights. And so what we did, and it's tough, we stayed away from trying to chase valuations that were far beyond what we thought was an appropriate valuation range. Now, in this market, every asset is expensive. So you have to start off with that notion. And you're going to expect it to be at the upper end of your range. And once it's in the range, then it doesn't really matter if you're investing in a good company. So my advice to people is, when you determine what you think is an appropriate value and you kind of know what your limit is, know that you'll kind of get to your limit pretty quick, but then you're going to have to be disciplined because what people do forget about, with some exception, the entry point is extremely valuable in order to generate the requisite level of return. And in a market in 10 years where people have this perspective that, there is the greater fool theory, that someone will always be there to pay a higher price. Yeah, that's been going on and going on longer than I even thought. But when it stops really fast and really nastily. And I think that's what's going to happen, at least in certain parts of the value chain.
And so let me ask you, which parts do you think are most at risk?
Well, you're seeing the public markets starting to become very rational. So when you actually look at, say, in the last couple of years, all of the Canadian tech companies that went public in the last 2 years are below their IPO value. Some of them unbelievably below. In the US, I don't have the latest stats. I think it's 7 out of 10 are below their IPO value. Now, that includes a lot of SPACs, where that's been a disaster for a lot of the retail investors. So again, I just mentioned, Facebook, PayPal, et cetera, but there's all numerous examples. Shopify, which is unbelievable, was down 50% from its highs. So there is some rationalization. Where you're going to see the real bloodshed, I think, is a lot of capital that went into late stage venture capital opportunities. And it was largely driven or fueled by a lot of what we call crossover funds. You said hedge funds, et cetera, that are not experts in the private markets and piled in capital at pretty insensitive valuations. And those values are tightly correlated to the public market valuations.
Right.
When those public market valuations have dropped, say on average 50%.
John, I want to pick it up on what we were just talking about in terms of, some of the damage we might start to see, and when the public markets start pricing maybe the scenario accurately. What's your thoughts here?
Well, the private markets are tightly correlated to the valuations of the public markets, particularly in late stage investing. And as we've seen a massive drop on average of the public company growth stocks, let's just use a 50% drop on average. That's clearly not across the board, but certainly a lot of the big names. You are not seeing yet the corresponding drop in the valuations of the private markets on those late stage. And then it starts to trickle on down. But I would say the most egregious pops in valuations have been in those later stage valuations of the popular growth stocks. And I think you're going to see massive corrections that in that particular area.
Okay. So tell me then, where do you see some massive opportunities? And it's so interesting. I had a conversation with somebody not that long ago who said, because we all think, let's just hedge against inflation. And he said, no, you have to far outperform inflation with the way the world is going. And technology, if you invest correctly, I believe you can hopefully manage part of your portfolio, your income, your lifestyle through that. And I think that's what you're thinking as well. That's your approach.
Yes. There's two types of technology investing in a very simple sense. There's investing in the specific technology company that's traditionally the tool to make other companies productive. Typically software businesses, it could be hardware, it could be semiconductor. That's one type of investing, but that's a smaller piece. It's the rest of the economy. Every other industry will need to adopt those technologies in their businesses to make their businesses more competitive, et cetera. So as an investor, when you're looking to make investments, it's really understanding all of those companies, in a sense, are all technology companies. And if you're looking at investing in companies that just refuse to adopt technology, there's going to be a technical term for that. It's called bankrupt.
Okay, so John, can you give us a sense in terms of a new technology that you're looking at, or are you invested in crypto? Are you invested in blockchain?
Yes. So I'll give you just two examples that I've been very, very bullish and started betting heavily, I'd say starting around 2016, 2017. So on crypto, betting on the currency or the speculation of crypto, like who the heck actually knows? And I think it's actually a bit of a mug's game, but the underlying technology, the blockchain, is absolutely here to stay. We are in such early innings, and understanding all of the applications. It's not about NFTs. It's not about investing in crypto, but it's that powering of the blockchain. That's area number one. Number two is the potential impact of quantum. Quantum has been one of those technologies that we've been always talking about for the last 30 years. We are seemingly getting closer to real quantum opportunities, in not just in these massive supercomputers, but getting to miniaturized opportunities. And I think that if quantum does become what it's intended to become, it actually changes everything that we do, actually, both for good and both for bad. So depends on what side of the fence you're on.
We'll see how that plays out. The bad side does scare me.
Yes, it does.
John, that's a whole other conversation, which we'll have you on again. I hope. I would love. Now, I've only got about 50 seconds left. My show, my program is called The Buck Stops Here. So I want to know, what is your buck stops here? What's your one-liner when you think about whether it's investing or philosophy?
Yeah, so somebody's asked me this question before in terms of all the investments you've made in your career, what is that single line that seems to connect all the winners? And it really boils down to finding the passion in the founder or founders that you're investing in. And what do I really mean by that is understanding why they're doing what they're doing. What big problem are they really trying to solve? And will they go at all ends of the earth in order to solve the problem? And it's not about making money. Those are the winners. Those have consistently been the winners. And whether you're investing in public or private companies, that to me is what I look for.
Okay. John, thank you so much for being here and with me today. It was far too short. Thank you. Thank you.